Hey, welcome back, guys. This is adding nuance to using price-to-book ratios, overview, precautions, and examples, part 2. So if you haven't watched part 1 yet, I encourage you to stop the video and watch that first. But if you have, now we're finally going to go into case studies. Here's where we actually go, okay, what sort of hidden value or what sort of hidden risks can I find if I actually take a look into the book value itself? Maybe I can find something that others have missed. Okay, so if you're ready, then got my coffee, got my sheep. Let's go. Okay, so helpful tip number 1. Look, using price to book as on an absolute basis. Here I'm going to go into the case study. Sometimes, so here's one tip. If you have to look at book value, here's one thing you could do. Net cash is sometimes overlooked in finance companies. There's a when people think of manufacturing, people just tend to think of P&Ls. Like, okay, does a product sell? Does a product not sell? The amount of cash on his books sometimes is overlooked, right? But sometimes you can find hidden value when you do that. Case study 1, Valuetronics. Let's go. So just want to point out, automated analysis can miss out hidden value. So here I just took out basically an example of like an automated analysis, right? If you go to this link, you can find it. It just says, okay, here's the PE ratio, gives you an idea of the historical PE ratios. Over here, it tells you what the PB ratio is. Then it gives you like the history of the PV ratios, right? And then after that, it just spits out the analysis. That's all it says. But you'll notice, right, that in all of this, right, there's no mention of net cash. If you just check it out, there's no mention of net cash because you have to actually parse the financial statements to get some sort of value for net cash. And that's a bit harder, right? So how do you calculate net cash? So here's an example. We have the balance sheet of Valuetronics here. So net cash should be, okay, let's look at cash and marketable securities. Okay, financial assets at fair value, that's useful. You have financial assets at fair value here again. Then you have cash and cash deposits. Okay, this is cash. Okay, net cash basically means you take your cash and you subtract off all your liabilities, right? The difference between cash and liabilities is your net cash. So I will ignore the other types of assets like, property. I'll ignore that, for example. Inventories, receivables, I'll ignore that. Trade payables, I'll ignore this. I make an assumption that the trade receivables and trade payables are gonna cancel themselves out. So I just look at cash and look at debt, subtract them. So if you do that, you'll get these values over here. So okay, so if you do that, add those things together, you get $195 million. Okay, the net cash, you take that minus off debt and you get this. By the way, when it comes to calculating net cash, some people are more stringent than others. Like some people will subtract all sorts of debts, So this is a little bit of art. Not everyone does it the same way. Okay, so I'm more conservative, so my value could be slightly less than other people's values. Okay, so here you have net cash, 175 SGD, and that makes a big part of the entire book value. Look at the entire book value. It is 212 million. Almost all of the book value is actually net cash. Okay. So this means that Valuetronics actually has 40 cents per share of net cash. So think about that, right? At one time, Valuetronics was trading at 46.5 cents a share at the low during the COVID market crash. 46.5 cents per share, but it has 40 cents of net cash in its bank account. Just give you an idea of how cheap it could be. It was. Now, why bother looking at net cash? Okay, well, net cash gives you downside protection, right? It's not because if you know that the company itself has this much net cash, the stock price can't fall too much below that, right? It can't fall too much because of you have actually so much cash on in his bank account. And the second thing which people kind of don't quite realize is that when your net cash is so excessive, it means, right, you actually have extra cash for investment purposes. That means you don't need all the cash for your operations. You actually have cash now that can be used for expansion and investment. You could basically buy another company over with that cash. That's why you have to put a premium on that cash, especially during crisis times. Okay, but what does this have to do with price to book cycles? Let's go on. Okay, so here is a analyst report, I think a couple of weeks ago, and essentially this person was trying to figure out what's the worst case scenario for Valuetronics, right? And what he did was this over here. He basically said, he looked at 2009, the crisis, and he said, oh, at the lowest point, Valuetronics was trading at 0.7 times price to book. Okay, and then he said that, okay, if during the high crisis time it trades at 0.7 price to book, if you trade Valuetronics today at 0.7 times price to book, what stock price will you get? And if you did that, you would get 35 cents. Okay, so this is an implication of like the kind of like the worst case, a very, very bad case scenario, and people and because of that, they use this as one of the justifications to say that, okay, so we're gonna put the target price at a lower level of 50. Okay. Now, for myself, I didn't look at it that way myself. If you look at a prior blog post that I wrote around the same time, I said I disagree. I said even with a financial crisis, I think it's still worth 60 cents. And even with a financial crisis and with the uncertainty of even further damage from COVID, I still think it's worth at least 55 cents like now. So I disagreed. I said this is too low, right? So why did I disagree? So why did I disagree with his usage of book value for a lower range? He said that, okay, the crisis valuation is 35 cents because history has shown that if people panic, they're going to trade down to 0.7 times price to book, right? So in a sense, he's looking at the price to book cycle and saying, oh, trade the same way. Here's where you have to investigate into the book and story of Valuetronics to decide whether that comparison is true or not. So what do you do if you did that? Okay, so let's look back at 2009 itself just to show you. So this is the balance sheet of 2009. And so if you calculate what, not the book value, but the net cash was in 2009, compare that to his book value, it's a different story in 2019. That's why it might not be fair to compare using book values the same way. Because one, Valuetronics isn't a bank or a REIT. So the book value per se is less useful to use historical book values in that sense. But what's important is the value of the book in this company. So in this case here, in 2009, net cash was 30 million, book value 58 million. What does that mean? It means that net cash only made up half of the book value, just half. That means everything else, the plant, the inventory, all of these things, the operating assets we say, is equivalent to the cash it had. They were the same size. Okay. We found that if you found the net cash per share, it was around 8 cents. And you found that the range in 2009, the company traded something like from 7.5 to 17 cents. I think it went below 7.5 cents, but only for like 1 day, so I didn't count that. You know, so as you can see, 8 cents, 7.5 cents, at the crisis bottom, at maximum fear, price didn't go much below cash value, right? So it seems that the cash value is, in a sense, more important to finding the margin of safety as compared to a book value. If you did that for 2019, you will find that net cash doesn't make up 50%, it makes up 82%. A very, very, very big difference, right? And then at the same time, we need to investigate the scenario in 2009 compared to now 2019, and you find that if you did that, Valuetronics was actually having two additional problems in combination with the GFC lower demand issue. It had a goodwill impairment because of a bad acquisition. So Valuetronics basically, prior to this, they did an acquisition and they tried to go outside of their core competency. They tried to go outside of manufacturing, and then that segment didn't do well, so they had to write it down. So they were still basically trying to digest this bad acquisition. And then they had flooding in their factory. So they actually had flooding. And then on top of that, then they had the lower demand because of the GFC itself. But today, it's a bit different, right? Today, we have a crisis environment in terms of lower demand and short-term supply chain issues. Okay, but this is just one issue and not like three. So when you look at these two together, you go, oh wait, the situation is not quite different, right? So if I use, and so then I go, okay, so then how do I value this company? Now, what I'm going to use right now is, I'm using kind of like a rule of thumb. Is not, I can't say I've got expert knowledge of what exactly is going to happen and what the supply chain is, but you try to just calculate a range of values based on what the situation might be. So I go, okay, net cash 40 cents a share. I know the price won't really go below that. Last year, they made 8 cents a share, okay, based on the last 6 months run rate. Okay, take the last 6 months, how much they earn, and then you annualize it. It's like 8 cents per share. Okay, so we know that going forward, earnings are going to get impacted. We know that. The question is how much? All right, so let's just estimate something. Estimate a range of earnings going forward. I'll say, okay, you know what? Let's just say that things are really bad, and for the next couple of years, earnings is going to drop by 50%, and you stay there at 50%. It's not likely, but let's assume that. Okay, just note that CIMB says that earnings will drop by 20%. I'm just being more bearish, minus 50 to minus 25. Okay, so let's say a super bad case scenario, bad recession, some clients pull out and never get replaced. So assume that earnings will drop by 50% this year and will not recover. Okay, if you do that, that means that they make 4 cents earnings per share. Okay, 4 cents earnings per share. That means that if I try to calculate what the PE is, removing the cash, this is a form of enterprise value. What I mean is this: take the market price of the company, okay? So that means it is right now, I mean 50, whatever the market price is of the company, okay? In this case, I'll give a target of 60 cents. If you take 60 cents as your target, first of all, I minus off 40 cents per share, because that's how much cash it is. So assume that I'm buying this company, and then if I buy the whole company, I can strip off the cash for myself, right? So I'm actually buying the business itself for 20 cents a share. 60 minus 40 cents, 20 cents. 20 cents, how long will it take for me to break even on my 20 cents? At 4 cents a share, it takes only 5 years to break even. So that means this is a 5 times PE x cash valuation. So at 5 times break even, right? Which is very conservative, right? That's a valuation of already at 60 cents per share. See, that means to say that, yeah, if earnings drop by 50%, it's not unthinkable that it can still trade for 50 cents a share. And that's if you're being conservative, right? So if it's less bad, so let's just say that less clients pull out and aren't replaced. And don't forget, these are situations where I'm saying that there's no growth. Earnings drop and stays there. Earnings drop and stay there, right? So if earnings drop by 25% and stays there, well, that's 6 cents earnings per share. If you did that, a conservative valuation of 5 times would be 70 cents a share. So from here, you can see my calculations aren't very precise. It just tells me that, hey, in these really bad scenarios, right, the value I can get from this is still quite high. Yeah, that's why I said that I thought that, even in a crisis, right, you still should get at least 60 cents per share. And if you're not in a crisis, if earnings drop this year and then it starts growing, right, then it's worth then say 60 and 70, right? So sometimes when you look at net cash, then you start to realize, oh wow, there's a lot of hidden value in the company, right? It's more than just PE, it's PE x cash. And finally, 40 cents is also your growing safety net because Valuetronics has proven to be a cash-rich company, cash flow company. So if you look at their cash hoard, it increases every year because as they earn, they pay some out as dividends and the rest basically goes back to the company. So that 40 cents actually is growing. Okay, what's next? Conclusion. When cash builds up large enough, it becomes important in valuation. Maybe if the cash was a small level, you might not think too much about it because you might think to yourself, well, they need to use the cash in your operations, so cash is part of their operating asset. True, but when it blows up until the cash is obviously, they have way more cash than they need, it means that that extra cash is freed for other strategic purposes, acquisitions, things like that. Yeah. And also, it's not just about that. It's also flexibility in so many things. It gives them an actual competitive advantage when you have that much cash, because now you can not just acquire. You can easily you don't need a bank anymore. You're not a slave to credit. You can write off like any financial crises or liquidity issues for a very, 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 very long period of time. There's so much advantages to that. When if you're a manufacturing company and you're trying to source for good clients, like you want really good clients, right? Good clients, obviously, there'll be different manufacturers who are trying to compete for their attention, right? Everybody wants to make that thing for this client because the client is a brand name client that pays well. So the extra cash, right, actually increases your profile because you can just go to the client and go, would you rather trust that company over there that requires a bank for credit, right? Or would you prefer to go with us that has so much cash we don't need to go through a bank. We don't need a bank for credit. Anytime you want to increase your supply chain, increase your demand, increase your supply based on demand, or even shrink it, or if you need us to hold your inventory for longer, right? I mean, we can do it easily. So it also helps in terms of your competition when you try to attract clients. Anyway, so when cash builds up large enough, it becomes important valuation. So yep, if you see price to book very low, look up for net cash. Maybe people are missing this out in terms of the way they calculate what the value is worth. Okay, helpful tip 2. Using price to book as an absolute basis. Okay, in this case, you can investigate goodwill and intangible assets. So one case study which I did, Mednex. At one time, it was called the medical growth stock. Couldn't do wrong. Okay, so here's why I did that. I think so. At this point in time, the market was saying, "Wow, it's a medical growth stock. It's a growth stock in the medical industry. 24 times PE. It's trading at 3.5 times book value." Well, on the surface, it doesn't seem out of the ordinary, right? Oh, growth stock, 25 times PE, reasonable. 3.5 times PE, well, that's not that bad, right? Well, hey, sometimes when you look into the book value, you see something different. So in this case, right, in order to make sense of this, you actually do need to know the story. So you actually do have to do your due diligence, and that's what I did. So I'm going to just summarize all these slides. Basically, this company grew by acquisition. So, in 2014, they really acquired all sorts of different medical practices, okay, from anesthesia to maternal fetal medicine to pediatric cardiology. They continued a lot of acquisitions in 2015. So this company basically borrows a lot of money, and then from the money they borrow, they just acquire. But I started to notice, right, that their margins were actually dropping. So even though they kept acquiring stuff, I noticed their margins dropping. So it told me either these acquisitions aren't accretive, or they're not performing, or they just can't integrate well, or there's no synergy. Something's not quite right. Okay, so this gave me a forewarning that future earnings are going to change because they kept borrowing and borrowing and borrowing. At a certain point, you cannot borrow anymore. And if you cannot grow by acquisition, then any fluctuations in your business, if it shows any if you cannot grow organically, then there's going to be some the earnings won't grow. In a growth stock, you get quite punished if people thought you were a growth stock and your growth stops. So I wanted to look more into the book value. Then I discovered, wow, there's a lot of risk to it. This company, because it acquired so much, it had a very big portion of its assets as goodwill and intangible assets. So what is goodwill? Goodwill is like this. when a company buys over another company, um, the price they paid for this company, anything that is on top of the actual tangible net asset of the company is just considered goodwill. Goodwill. It's like, oh, it's the premium that you paid over its tangible book. So the key thing about goodwill is that when the company that you bought is performing well, you could say that the goodwill that you paid is worth something. But if what you bought is actually not performing well, that goodwill can be worth nothing. And that's the scary part, right? So when I looked at it, it turns out that if you strip out all of the intangible asset and just look at the tangible assets, you actually get a negative tangible equity. In other words, it had way more debts than actual physical assets, to the tune of minus 1.4 billion. So there's no tangible safety net. Okay, so even though the price to book was 3.5 times, a lot of that book value was intangible, and the actual price to tangible book was actually negative. So imagine that um, there's no, for a stock like electronics, you have 40 cents of pure hard cash. If the stock goes below 40 cents, some activist guy is going to go, you know what, I can just buy this company and just strip it out and take the money back. So there's actual floor. This company doesn't have a floor. It's solely dependent on its growth and its business model. Okay, now of course I did more analysis, and I realized that their debt burden was actually pretty hefty. To give a context, right? If you looked at how much they earned every year, right? Their net debt was basically 5 times larger than its net earnings, which means that if their earnings remain at this level and they took all of their earnings just to pay back their debts, right, it would take them 5 years. Okay, 5 times. That's quite hefty. But more importantly, right, look at the interest expense. When I calculated the interest expense, I found that the interest expense, right, takes up 20% of the net income level. That's a lot. So imagine this, right? If interest rates double, don't forget, when I did these calculations, right, the economy was was in expansion mode. So the Fed was already implying they're going to increase interest rates. So imagine that if you go from it, if the interest rates just double, then the interest expense will jump from 20% to 40% of income. I mean, that boggles the imagination, right? So you have this thing going on, and I knew that was coming. So if the earnings cannot increase to the same proportions, right, this stock is not going to be considered a growth stock anymore, and it won't be trading at 20 times PE. So anyway, as it happens, right, that basically happened. The acquisitions essentially did not perform that well, and because of all these structural problems, right, the price got destroyed down. Yeah, so sometimes when you look at the price to book, you realize, oh my goodness, it's got so much intangible asset, and even if you have intangible assets, right, it doesn't mean that it's worthless. Like, for example, Coke has the Coke brand, right, and that brand has a value to it, has intangible value to it. That's something that I think other companies might pay a premium for, right, for your brand. But in this case, these tangible assets were goodwill, right? And so we have to investigate to see whether all those acquisitions are working out. Okay, so the conclusion for Mednax, right, is like this. So even though Mednax had a book value, it had negative tangible book value. The goodwill is the premium over book value they spent to buy those companies, right? And then there is no safety net to fall back on, large debt. Okay, interest on debt took up 20% of earnings. So if rates double, that's 40% of earnings. If acquisitions cannot integrate well or don't grow, lower earnings growth coupled with high debt burden with inevitable increasing interest rates will crush the stock. Okay, so actually, if you're looking for candidates to sell or to go short, right, you always want to find the companies that have very high debt burdens, and they're going to go into a high interest rate environment. Yeah, and then you want to see how are they been growing? Are they growing because it has actual organic growth, the main business is able to grow, or are they growing through artificial means, meaning I'm just going to acquire more and more companies to grow, and these companies might not have the synergies that you expect. Yeah, so these are just things that you can look out for. Okay, so final conclusions in this whole exercise, 2 useful tips. One, historical price to book trends may tell us something about the stock performance. Okay, we saw how looking at banks and REITs and different companies, how different types of asset classes in different types of stocks in different sectors tend to react differently, and even within the same sector, different companies can react differently in terms of their price to book cycles because of individual issues with those companies. And then two, when you actually investigate into the book value itself, you can find hidden value or risks, you know, and maybe you can you know something the market doesn't know, and you can act before the rest of the market acts. Okay. All right, you made it to the end. Okay, so hey, if you want to see more of my time market updates in a timely manner, please, if you haven't done it already, subscribe to kwanzombie.com and be on the mailing list. Now, if you don't check email but you check Facebook, please join the Facebook page, okay, kwanzombie.com as well. Now, if you want to get material on the financial markets from a Christian point of view, join this Facebook page, Financial Markets and Godly Wisdom Fellowship. You know, I put the same materials on both, except here I also put in a bit more biblical stuff, and I include more of my Christian testimony. Finally, if you want to be part of my journey at the moment, because I'm writing a book about my miraculous recovery from incurable eczema. I had eczema for over 20 years, one of the worst in Singapore. You can see pictures of it, and the doctors couldn't help me for the last 20 years. So when I found myself back with God and I saw Christ and grace in a new way, things just happened to my life, you know, including breakthroughs in my career and my health. And here's where I put that journey in. So if you want to be in touch with me for that, please subscribe to the mailing list here, letterstoamoderndayJob.com, like Job in the Bible. And finally, if all this materials have been an encouragement to you, and if you want to help to keep the lights on, and if you want to keep my sheep from being so stressed, yeah, they're getting stressed out. Yeah, so you want to send a love gift, right? Send an email to kennethkwanzombie.com to let us know you are sending a love gift, and here's the PayPal link over here. You can find it in the description below. Okay, so have yourself a good evening, and I will see you soon.